For liabilities of subsidiary company, example trade payable, increase in fair value, the fair value is greater than the carrying value of acquisition loss. The decrease in the fair value is less than the carrying amount on acquisition date is a gain. If it is a loss, deduct. If it is a gain, add. Add fair value, increase the amount to respect to liability in consolidated balance sheet. Deduct fair value, decrease the amount from the respect to liability in consolidated balance sheet. This is okay. Fair value increase, decrease the amount in liability. Subsidiary company will give even question. Fair value increase, decrease in amount in liability of the subsidiary company will be given in question. For assets of subsidiary company, example land, inventories, plant and machinery, etc. Increase in fair value is greater than carrying amount on acquisition date, gain. Add fair value increase amount to pre-acquisition reserves of subsidiary company, and add fair value increase amount to respective asset in consolidated balance sheet. Decrease in fair value less than carrying amount on acquisition date loss. Deduct fair value decrease amount from pre-acquisition reserves of the subsidiary company, and deduct fair value decrease deduct fair value decrease amount from respective asset in consolidated balance sheet. Note: amount of fair value increase or decrease in asset of subsidiary company will be given in question, but in case of depreciable assets, example plant and machinery, we may have to calculate amount of the fair value increase decrease as follows: fair value of asset on acquisition date less carrying amount of the asset on acquisition date, fair value increase decrease. Example, financial year 1/4/2023 to 31/3/2024. Acquisition date 1/10/2023. Consolidation date 31/3/2024. Carrying amount book value, if book value of plant and machinery of subsidiary company 31/3/2024 13,50,000. Depreciation rate 10%. Fair value of the plant and machinery of the subsidiary company 1/10/2023 20 lakhs. Solution: carrying amount of the plant and machinery 13,50,000 divided by 90 percentage. See, question we need to understand properly. Financial year 1/4/2023 to 31/3/2024. Acquisition date 1st October 2023. Consolidation date 31/3/2024. Carrying amount book value of plant and machinery of subsidiary company on 31st March 2024 13,50,000. Depreciation rate is 10%. Fair value of the plant and machinery. Fair value of plant and machinery of subsidiary company on 1st October 2023 is 20 lakhs. Solution: carrying amount of the plant and machinery 13,50,000 divided by 90 percentage. That's called 15 lakh. Carrying amount of the plant and machinery on 1/10/2023, 15 lakh minus 15 lakh into 10% into 6/12. Then what is coming? 14,25,000 is coming. The fair value increase in plant and machinery. Fair value increase in plant and machinery on acquisition date is 1/10/2023, 20 lakh minus 14,25,000, that is equal to 5,75,000. Like this you need to come. So the plant and machinery on 31/3/2024 is 13,50,000. How 13 lakh 50 is came? After depreciated 10 percentage. Now you add the depreciation. Then what is the carrying amount? 15 lakhs. On 15 lakhs, you take depreciation 10% for 6 months. Then 40 lakh 25,000 as on the middle of the year. But that middle of the year, how much assessed the plant and machinery? He assessed for 20 lakhs. Then 20 lakh minus 40 lakh 25, how much? 5 lakh 75. This is the adjustment for everywhere plant and machinery, my dear friend. Very, 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 very important adjustment. Every time in exam he will give. Remember, remember, remember. Very, 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 very important. Okay? For example, a 6 lakh asset as on 1/4/2024. But depreciation is 10 percentage. As on 31st October 2024, 23, the value is 20 lakhs, for example. Then what you do? 6 lakhs divided by 90 percentage. Then this much should be there. Into 10% depreciation into 6 by 12, this much. 33,333 you need to reduce. 6 lakh 60,000 minus, then 6 lakh 63,000. This is minus 20 lakhs. So this is a common adjustment everywhere, every time. So you need to diligently remember that one, and you need to do diligently. We need to act in diligent manner. Diligently, money will come. This is sorry. Diligently, this is diligently will come. Okay. In case of depreciable assets, in case of depreciable assets, additional effect for depreciation due to decrease in fair value of asset of subsidiary company is also given as follows. Depreciation on fair value of the asset from acquisition date to consolidation date less depreciation less depreciation on original amount of the asset from the date of consolidation date. Additional depreciation to be charged, depreciation to be reversed. See, in case of depreciable assets, additional effect for depreciation due to decrease in the fair value of asset of the subsidiary company is also given as follows. Then depreciation on fair value of the asset from acquisition date of consolidation date minus depreciation in original amount of the asset from the acquisition date, consolidation date. This is very, 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 very important significance. This also. అసలు నాకు తెలిసి ఈడు ఎన్ని ఎగ్జాంపుల్స్ ఉన్నాయి అన్నాడు. He said 253 pages contain 110 examples. Why we can't do this 110 examples and then go for exam? Huh? That's better, no? Let's do all 110 examples by pen and paper rather than go doing all this now and fearing about life. Let's let's note down this example, my dear friend. Very, very, very important thing only. Example 1. Example 1. Financial year 1/4/2023 to 31/3/2024. Acquisition date. Acquisition date 1/10/2023. Consolidation date consolidation date 31/3/2024. 31/3/2024. Carrying amount, book value of plant and machinery, carrying amount, carrying amount, book value, carrying amount, book value of plant and machinery of subsidiary company of subsidiary company of subsidiary company of subsidiary company on 31/3/2024 rupees 13,50,000. DEP rate 10 percentage. Fair value of plant and machinery fair value fair value of fair value of plant and machinery of subsidiary company of subsidiary company subsidiary company on 1/10/2023 20 lakhs. 20 lakhs. Now, solution. Solution. Carrying amount of plant and machinery on 1/4/2023. Carrying amount, carrying amount, carrying amount of plant and machinery, carrying amount of plant and machinery on 1/4/2023 is 13,50,000 divided by 90 percentage. That is equal 15 lakhs. 15 lakhs. Carrying amount of the plant and machinery 1/10/2023. Carrying amount, carrying amount of plant and machinery, carrying amount of plant and machinery on 1/10/2023. 2023. 15 lakhs minus 15 lakhs into 10 percentage into 6 by 12. That is equal to 14,25,000. 14,25,000. The fair value increase in plant and machinery fair value fair value fair value increase fair value increase in plant and machinery on acquisition date. On acquisition date. On acquisition date. On acquisition date 1/10/2023. 20 lakhs minus 20 lakhs minus 14,25,000. That is equal to 5,75,000. This is one is super adjustment. Now, in case of depreciable assets, additions and effect for depreciation due to increase decrease in the fair value of asset of subsidiary company is also given as follows. Depreciation on fair value of the asset from the acquisition date, consolidation date, minus depreciation on original asset of of amount of the asset from the date of from acquisition date to consolidation date. Additional depreciation to be charged, depreciation to be reversed, additional depreciation to be charged, deduct from the post acquisition retained earnings of the subsidiary company, and deduct from the respective assets in consolidated balance sheet. Depreciation to be reversed, add to post acquisition retained earnings of the subsidiary company Depreciation to be reversed. Add to post-acquisition of the retained earnings of subsidiary company and add to respective asset in consolidated balance sheet. As per above example, depreciation on fair value from 1/10/2023 to 31/3/2024, 20 lakhs into 10% into 6 by 12, 1 lakh. Less depreciation on original amount, 15 lakhs into 10% into 6 by 12, 75,000. Then 2 lakh additional depreciation to be charged. Oh, దీనికి ఇలా ఇస్తారా 5,75,000 into 6, 5,75,000 into 10% into 6 by 12. Oh, 28,750. So, ఇక్కడ రాద్దాం. For the purpose of additional depreciation, for the purpose of additional depreciation, for the additional depreciation, working below workings below. For the additional depreciation, workings below. For the additional depreciation, for the addition, ADDITIONAL, for the additional depreciation, workings below, for the additional depreciation, workings below, depreciation on fair value, depreciation on fair value, on fair value, depreciation on fair value, 1/10/2023 to 31/3/2024, 20 lakhs into 10% into 6 by 12 is equal to 1 lakh. 1 lakh. 1 lakh. Depreciation on original amount less depreciation on original amount. Depreciation on original amount. Depreciation on original amount. Original amount. depreciation on original amount from 110 2023 to 31 3 2024. 15 lakhs into 10% into 6 by 12, into 10% into 6 by 12, 75,000. 75,000. Additional depreciation to be charged 25,000. ADDITION. Additional depreciation. Additional depreciation to be charged. To be additional depreciation to be charged 25,000. 25,000. The final amount of depreciable asset subsidiary company to be taken for the consolidation, carrying amount of the asset as on consolidation date, balance sheet of the subsidiary company, add or less fair value increase or decrease, less depreciation to be received, additional depreciation to be charged. As per above example, carrying amount as per above example, as per above example, as per above, as per above example, for example, carrying amount of the plant and machinery as on 31st March 2024. Carrying amount of plant and machinery, carrying amount, carrying amount of plant and machinery, carrying amount of plant and machinery as on 31 3 2024, 13 lakh 50,000. 50,000 plus fair value increase, add fair value increase, add fair value, add fair value increase 5,75,000. 5,75,000. Then 5,75,000. Then the value is 19,25,000. 25,000. Less additional depreciation to be charged. Less additional depreciation to be charged. Additional depreciation. Additional depreciation to be charged. 25,000. So value is 19 lakh. Like this we need to do. If there is a increase decrease in the fair value of inventory of subsidiary company on acquisition date, that inventory get sold after acquisition date but before consolidation date, in this case effect of previously recognized fair value increase decrease on such inventory is reversed as follows. If there was increase in fair value of inventory on acquisition date, deduct such fair value increase amount from post acquisition retained earning of the subsidiary company. Deduct from inventory in consolidation balance sheet. Okay. If there was a decrease in the fair value of inventory on acquisition date, add such fair value of decrease amount to post acquisition retained earnings of the subsidiary company. Add to inventory in consolidation balance sheet. అర్థం కాల పాయింట్ ఎగ్జాంపుల్తో సహా చెప్తే కానీ అర్థం కాదు. If there is an increase decrease in the fair value of inventory of the subsidiary company on acquisition date, that inventory gets sold after the acquisition date but before consolidation date. In this case, effect of the previously recognized fair value increase or decrease in such inventory we were reversed as follows. If there was increase in the fair value of inventory on acquisition date, deduct such fair value increase amount from the post acquisition retained earning of the subsidiary company. Deduct from deduct deduct from deduct from inventory in consolidated balance sheet. Deduct from inventory in consolidated balance sheet. If there was a decrease in the fair value of inventory on acquisition date, add such fair value decrease amount to post acquisition retained earning of subsidiary company and add to inventory in consolidation balance sheet. Add to inventory, add to inventory in consolidation balance sheet. Oh, add to inventory in consolidation balance sheet. Treatment of unrealized gain on inventory. It happen. It happen if there is an increase decrease in the fair value of inventory of the subsidiary company on acquisition day, that inventory gets sold after acquisition date but before consolidation date. In this case, effect of previously recognized fair value increase decrease on such inventory is reversed as follows. Disposal అయిపోయింది కాబట్టి now treatment of unrealized gain in inventory. It happen when treatment of unrealized gain in inventory. It happen when sale or purchase of inventory takes place between parent company and subsidiary company during the parent and subsidiary relationship, and that inventory is laying in the stock remained unsold. Consolidation date, downstream transaction. Parent company sold goods to inventory. Parent company sold goods to inventory to subsidiary company. Unrealized gain on inventory. Sales account. Sales amount minus cost of such goods. Deduct from the group of the retained earnings. Deduct from inventory is consolidated balance sheet. Upstream transaction, subsidiary company sold goods inventory to parent, unrealized gain on inventory, sales amount minus cost of such goods, deduct from post acquisition or retained earnings of the subsidiary company, deduct from inventory in consolidated balance sheet. Treatment of unrealized gain on PPE. It happens, it happens it happens when sale or purchase of the PPE takes place between the parent company and subsidiary company during the parent subsidiary relationship, and that property plant and equipment is laying remained unsold on consolidation date. Downstream transaction, parent company sold PPE to subsidiary company. Unrealized gain on PPE, sale amount minus carrying amount of such PPE on sale date. Deduct from group retained earnings and consolidated balance sheet. In this case, subsidiary company would have charged depreciation on the total value of the PPE purchased amount from parent company, and so additional depreciation charged by subsidiary company on unrealized gain portion of the PPE to be reversed as follows. Add to post-acquisition retained earnings of the subsidiary company. Add to PPE in consolidated balance sheet. Add to PPE on consolidation date.